saving institutions, which was the main organization, national organization, several of these more conservative thrifts dropped out. And in fact, there are about 1,500 healthy thrifts left in the country. Most of them are those that
didn't play the game.
Exactly, stayed conservative. So there might be a lesson there somewhere. Now, we got the boom going, and then all of a sudden a bunch of forces began to converge. As we've said, these high interest rates they were paying, the high-flying living, high cost of living. In 1985, oil prices dropped. Been up to $30 a barrel, suddenly dropped to 11. Okay. So, right away, several of the developers and investors who were putting together these enormous projects that the savings and loans were funding defaulted. Okay. Now, that started the slide.
This is around 86?
This is
85, 86? 85. Okay.
Okay. In 86 came the big hit. Okay, and the big hit was the second Tax Reform Act of the Reagan years, in which he reneged on all of the deals of the first Tax Reform Act. So in other words, accelerated depreciation, retroactively cut off.
Retroactively?
Retroactively. Suddenly, they had to refigure all the taxes back on a straight line life of the asset basis.
They say, hey, okay, I want my cookies back. They say, wait a minute, they flushed down, I mean, they're in,
That's right.
down the Arkansas
That's
River
right.
a long time
and so
ago.
all of these people who had taken this enormous tax break suddenly
had to make it up.
Had to make it up. And so they all, I mean, almost 100% defaulted on their deals. They couldn't make any payments. The escrow accounts that were set up as the original part of the deal were running out. And all of these deals fell apart. Now, the developers were in another serious bind because when a property was foreclosed, and if the S&L forgave the debt and didn't chase you, the IRS treated that forgiven debt as income. Okay, so if you were forgiven a $700,000 debt, then they sent a little form to the IRS, and the IRS said, well, you owe us taxes on $700,000. Plus, any depreciation that they did get from the now straight line depreciation was treated as a capital gains. So they had to pay capital gains tax on what they had written off. So everybody declared bankruptcy. I mean, it's a joke now, but if you look at the curves by year of bankruptcies in Texas, it goes, and then boom, like that. And that's the reason. I mean, they just had no choice. So now the dream is over.
The party's over.
The party is over.
And the hangover is very heavy.
That's right. And so all the savings and loans now have to foreclose. Now, when they foreclose, in most of these deals, the property was set up as collateral. So now all the savings and loans suddenly are taking in all this property. Now they're taking in apartment buildings, they're taking in developments that have a few roads in them, and they got the golf course up. You know,
but no people living there.
There's nothing there. Empty office buildings, they got nothing. Now this is. These foreclosed properties are called real estate-owned on the books of the banks. So they're known as REO property for short. REO was a real problem for banks, savings and loans, because first of all, they had to take care of them. I mean, you got apartment buildings, somebody's got to manage it, somebody's got to get the rent, somebody's got to clean them up, maintenance, all of that. They got to pay taxes. If you got a development that was half finished, you had to finish it. And suddenly, they were in the serious development business, and they didn't want to be. So, that was the first problem. The second problem was that REO was subject to regulatory write-down. Okay, now, what does that mean? Well, the regulators would come in and they'd look at the REO that you had on your books. If you were carrying, they were supposed to be trying to sell this to get back their investment. If you couldn't sell it, the regulators would come in and actually arbitrarily drop the value.
Yeah. Well, which was realistic, though.
Exactly, because it wasn't selling.
Or it wasn't even developed in some cases.
Yeah, that's
and
right.
They didn't have the capital to complete the project.
That's right, but you can see what this did to the banks, to the savings and loan. Right? The profits go down, no more bonuses based on profits. Their capital reserve go down, now they're technically insolvent, and the regulators are banging on the door, they're going to close them. In one case, I'll give you another example from Lamar here in town. They had a development out on Route 2222, it's out west of town here. Enormous development, golf course, a little water company made water. 1,200 homes, many of them in the high dollar bracket. It was called River Place. Well, they sank $63 million into River Place. When they foreclosed on it, they got, I think, 100 homes, the golf course, and the water company, and the land, the roads. Over time, the regulators wrote it down, and the eventual final write-down value was $5 million. So on that one deal, Lamar lost, gone forever, $58 million.
Which was actually in the pockets of all the people to start out with.
That's right.
The bank people and the construction people.
Developers,
now it's
the appraisers, everybody who skimmed some of the action.
So the money is gone, but it's gone somewhere else, in their pockets or in offshore banks or
That's right.
CIA or mafia.
And the whole thing, remember that the whole value was originally inflated by those appraised values, by all of that. So REO property was an enormous problem for the S&Ls. And this is where the owners, the executives, stepped over the line. Okay, now they've been living the high life for a few years.
Legally, huh?
Legally, originally.
Right.
Okay, even though we know it's a figment of their imagination, it was legal. But now they got all this REO, and they got to get it off their books. So they developed some schemes to get it off their books. One thing they did, for example, was a simple deal called a sham transaction. You got a friend, okay, you were the owner of the bank, you sell apartment building to your friend. And you write into the deal, you will not be held responsible for this loan if you have to foreclose. And they'd put in the interest and all that. And, you know, you'd be allowed to take a couple $100,000 out of the operating expenses, or you get your money somehow. Okay. Now, what this did was it took the REO off the books, gave it to you while I'm looking for a buyer.
But I didn't have any responsibility because in the contract you said if I defaulted, I wouldn't be held liable.
Exactly. There was a case here in town, for example, another Lamar case. The owner had a friend named, an Indian guy named Vijay Parikh. And there was an apartment building here in town that was REO. And Lamar sold the building to Vijay Parikh. And during the trial, he was tried and convicted of fraud. During the trial, it came out that Parikh didn't know how much the loan was that he was getting, what the interest rate was, what the payments were. I mean, he just didn't know anything.
They just gave him the money to take the thing off their hands.
Right, and of course, no money really exchanged hands. They just said the apartment building's in your name, and you just borrowed, you know, the worth of the apartment building from us. Right.
And it's up to him to develop it and to run it.
Yeah, exactly. And he held it for 6 months or so, and actually he was actually a pretty good property manager, apparently. And then a buyer was found, and it was sold. He didn't even know the name of the buyer, by the way, when it happened. He sold his own property. He didn't know who it was sold to.
It was all done by Lamar.
Yeah. So this was just a way to hide, get it off the books. And so these are the kinds of transactions that most of the indictments that you read about in the papers are focused on.
This is after 86 or 86 and after.
86 and after was most, 85, 86 where most of these deals went down.
Well, what about some of these things that they did that you told in a previous program where S&Ls would sell their bad assets to another S&L when they knew the bank examiners are coming in.
Exactly.
And then when the bank examiner left, then that S&L would sell them back to the original S&L.
Those were called daisy chains.
Yeah. Now,
and this was the same problem.
Are those legal or are those illegal?
Oh, they're illegal because it's a means of hiding the true worth of the bank from the regulators.
So they had a whole bunch of these schemes.
Exactly.
little scams.
But they were all focused around this REO, which happened after 86 and 85 when oil prices dropped, and more importantly, when the Second Tax Reform Act came through. And effectively cut the legs off of the industry. Well, I just wanted to clear up a couple of other kinds of deals that you may read about. Okay, there was one, we've already talked about daisy chains, and if there was just two savings and loans, it was called trading a dead horse for a dead cow. You take my dead cow, I'll take your dead horse. There was also a kind of transaction called cash for trash. Okay, and this has become quite important, and is the thing that they're after Silverado about.
Sound like a TV program, doesn't it?
Exactly. Well, it's sort of the way it worked.
Bad game show.
That's what it was like. Because here was the deal. If a developer came to the bank and said, I need $50 million to develop this development, the bank would say, fine, we'll loan you the $50 million. But actually, we want to loan you $60 million. And you take that extra $10 million and you use it to buy some REO from us. So it was another way to get REO off the books. Now, remember I was telling you about this land flip up in Dallas with Lou Reese, who $5.3 million, he sold it to himself a couple times.
10, 15.
Right. Well, in 1985, Lamar Savings contracted with Lou Reese to buy the property from himself again, this time for $28.5 million. Okay, 2 years before he paid $5.3 for it. But they loaned him $37 million. Now the extra was transferred to another company that Reese owned, and that company used that money as down payment for 2 shopping centers that Lamar owned, that they had to foreclose on. Exactly.
So that's playing an inside game of circulating your bad investments.
Exactly. So once again, another trick to get REO off your books.
And was this illegal?
This was very illegal, and in fact, 4 Lamar executives were indicted 2 weeks ago. This was one of the transactions that was named in the indictment.
And what about Eddie Reese ultimately? Did his development projects flop? I think I saw something on TV about that.
Well, he says that he took the $28 million and he put it into developing this property, this DeSoto property. And he had a deal with Lamar that 6 months later, once he had the structural things in, that they would lend him more money to build homes and so forth. And he claims that when he went back to Lamar to get more money, they reneged and said they weren't going to give him any more. Lamar says that they weren't going to give him any more because he pocketed 10 of the $28 million. Which, of course, he did. I mean, what would you do? So, REO is the problem. Now, there was a bank in Denver, Colorado, that's gotten quite famous, called Silverado. And one of the reasons they're famous is they had a nifty, creative way to get rid of REO. Now, of course, this is the one where Neil Bush is on the board. And in fact, Silverado is kind of a classic example of many of these things that we've talked about. They used these structural changes to build Silverado into an enormous dream.